And to answer all of that, we are being joined by Mr. Maneesh Dangi, who is the founder of Mosaic Investing and Research. Hi Manish, always a pleasure talking to you, and thank you so much for your time. First of all, wanted to sense your sense on the markets then, because it's been the global sell-off that we are witnessing for the past couple of days, though at least for today the Indian markets are showing some resilience. But what's your sense that will India be left behind, or like will India catch up the kind of sell-off that we are witnessing across the world? What's your sense coming in on the markets right now?
Hi. So, market has had a few levers why market puked a bit. One, of course, is a short-term one, which is the macro spasm that it's going through because of the carry trade yen. Everyone has talked about it, so I won't spend much time. The only point I have there is that the pain of the unwind of the yen carry trade actually is in short term. In medium term, actually, it paves way for a better macro. China, India will have a more opportunity to sort of cut rates and ease financial conditions, so to say. So in a appreciating dollar regime, it becomes very, very difficult for emerging market to stimulate. So I think, that macro spasm, which market in the West particularly, but generally people are going through, I think that will unwind and it will pave way for a better macro. I think the other two parts, which is valuation and economic growth, those are more durable in nature and the pain could persist. Valuation, of course, as everyone has talked about in India and also in US to a certain extent, is very expensive. And no one knows what's going to happen in the next 3-6 months. But at these valuations, it's very, very unlikely that you will get a good risk premium. And there is incrementally all the signals of economic slowdown, both in US and India. So we may go through a little bit of a soft patch. So these two parts, valuation and economic slowdown, are actually here to stay. The yen carry trade stress would actually unwind sooner than later.
Right, Mr. Dangi, good afternoon. This is Vinny joining in the conversation as well. All things put in place. Yesterday, what we saw because of the global and macro effects, we saw a fall coming in. Now, today, what was the story that changed? Nothing changed overnight. Everything is still the same. How should one be viewing these, small sell-offs that we see coming in or small corrections coming in? Is this a worry or some trigger that one should be watching out for, a bigger fall maybe that one could watch out?
I think that's the trick of the market, right? If you have trending markets, lots of money, levered money comes in some form or other in the risk, which actually didn't have the appetite, and these macro events happen and flush out that risk. So I think for a long-term investors, these are sort of noises. You really can't ignore valuations and economic regimes, but you can almost certainly ignore what's happening, let's say, in yen. So how to sort of look at it is look through it. And if you think that the sector, the industry, the firm that you are betting on has reasonable prospects, these are good opportunities for you to dial in risk. But if you are macro investors worried of economic regime turning into a slowdown in India, or valuations are too expensive for you, even if it unwinds, it's not an opportunity for you to actually dial up again. In this setup, of course, it is signaling significant space for the bonds to rally. So that remains my active bet, both in US and India. It's very, very likely that interest rates in 10-year bonds will be heading, let's say in India, towards 5.5% over the next 1 to 2 years. Maybe 2.5 years, and something similar in the US, where 10-year bonds from current near 4% will head to 2.5-3%.
Right, Mr. Dangi, yesterday when we were talking to Jim Rogers, one point that he highlighted that whenever the sell-off comes now, that would be the worst that he would be seeing in his lifetime. Is that something that one should be worried about? Is that a major risk, and how should an investor be placing themselves now?
No, that's an exaggeration. He's made this point over and over again. Look, markets are cyclical. There would going to be, pain here and there for a variety of reasons. You can always have this view that, markets are over-levered, that his view is. The overall debt to GDP in the world have risen, productivity has fallen. Whereas there are a lot of people who are actually optimistic. I think the better lane to be in is to assume markets are cyclical. When they're cheap, sort of you can dial up risk, and when they're expensive, you can shed risk. So that's a better way to look at markets than taking these extreme views, in my view.
All right, and lastly, Manish, just wanted to understand from you that are there any areas of any pockets of opportunities where you are eyeing at currently, and also wanted your quick take on the PSUs, because just a while back we had the DPIM secretary and he did say that they are targeting value creation in the PSUs as a strategy. But as a value investor, would you eye any of the PSUs then?
No, I don't think PSUs are long-term bets. Of course, cyclically they've done really well, but governments change, their capital allocation policies change, what they want from PSUs continue to change. So you don't have a single management sitting in PSUs actually. So I don't think at these valuations, given that what they've done, it makes sense for investors to actually dial in that risk. Generally, it's time for you to hide in places which actually do well in early part of bear markets. Stuff like FMCGs, utilities, they do well. It's also a time when, instead of Indian cyclical or local cyclical, you move into a global cyclical because you have better protection there. I think Indian discretionaries are extremely expensive. Manufacturing is much more expensive than services. So you should flip that rate. Lots of these specific themes like defense and all or capex themes in India are extremely expensive. So I think investors should sort of stay away from them. Same thing for small and large cap, small and mid cap also. You should rotate back to large cap as much as possible. And above all, actually, bonds look extremely attractive. So I still think, the bonds will deliver as much as equity in next 2 years. So I think it's the time to buy long-term bonds.
Long-term bonds is what also you're looking at, Mr. Dangi. But, thank you so much for giving us your time and talking to us today this afternoon on ET Now, keeping an eye out on all those updates that we got in from Maneesh Dangi. Bonds is something that surely is an interesting space.